Coming up on today's show, stocks rip up higher across the board with the Dow breaking out to a new all-time high on the back of a significant change in the Fed dot plot. We'll look at exactly what the Fed said and what it means for markets. More data shows inflation cooling. Apple closes at an all-time high, and all the latest on commodities, cryptos, and a lot more. Hey, what's up guys? Welcome back to the Click Capital Daily Market Show. I'm your host Jared. I hope you're doing well out there. And what a day it was on Wall Street. One of the most bullish days we've seen in a while. And this time it wasn't led by mega cap tech. They were actually a bit soft as a group today. It was the small caps that were winners and sectors like utilities, which are loving these lower bond yields that we got today, along with REITs, some huge pop-ups in regional banks, along with some good moves up in healthcare stocks. And that was all thanks to this guy here, the rate guy who lit an absolute fire underneath the market today by pretty much signaling to the market they are done hiking rates and actually plan on cutting rates 3 times next year. So we got the updated Fed dot plot, which allows all Fed members to anonymously predict where they see rates going in the future. And so back in September, members were forecasting rates between about 4.5 and even above 6%. We still had some members thinking we had a hike or two left in the bag. However, no members think we're going to hike now, and this latest updated Fed dot plot actually moved down significantly from the average interest rate projection for next year at 5.1% in September. Now the average rate they're projecting for next year is 4.6%, which implies about 3 cuts, 0.75% in total. Also getting updated from their September projections was change in real GDP only coming down slightly. They expect unemployment rate next year to still be 4.1%, so a little bit higher where we are at the moment, 3.7. They expect PCE inflation to come down, along with core PCE, and there's the big one today the markets love, their projections of what they think the Fed funds rate will be next year, 4.6%. However, Fed fund futures have taken it a step further, assigning 0% chance that they're going to hike again, and now even giving close to an 80% chance they're going to cut come March, and now projecting 1.5% in cuts come next year. Fed fund futures are predicting we'll have the Fed funds rate at 3.75 to 4% next year. That's ahead of what the Fed thinks. The Fed thinks we're going to be around here, 4.5, and so it could be a scenario where we don't really get a big crash or break in the economy, rather just softening inflation towards 2%, and the Fed can just cut rates gently. However, looking at the Fed fund futures here, for the Fed to cut that drastically next year, that would be a recession or something breaking in the economy. And who knows, they may be right, because as per usual, they are ahead of the Fed and pretty good at pricing the future. And there wasn't a whole lot changed in the latest Fed statement we got today. This is the exact same statement from their October meeting, and what you see in the red and underlined is just the new words they've added in. So they just added in recent indicators suggest that the growth of economic activity, instead of expanded at, they said it has slowed from its strong pace in the third quarter. Job gains have moderated since earlier in the year but remain strong, and the unemployment rate has remained low. Then back in October they said inflation remains elevated, but today they said inflation has eased over the past year but remains elevated. So Jay Powell still tried to sound cautious, said inflation's too high. Didn't want to officially go on pause, even though they pretty much have done, but the market didn't care about that at all. The market was really just fixated on the change in the Fed dot plot, and the stock market is celebrating the likelihood of the soft landing and being able to reduce rates just on the back of cooling inflation, not something big breaking out there. And this is exactly what the Fed and Jay Powell wanted, so they must be pretty happy with themselves, and they see inflation slowing down to 2.4% next year. And this last couple of months, inflation data has been trending down, and we saw that again today. With wholesale prices flatlining in November, PPI coming in less than expected. Economists were predicting core PPI month over month to increase 0.2%, it flatlined. Same with the headline as well. And what's really helped inflation come down and the Fed is the price of crude oil falling drastically over the last couple of months. After reaching almost $95 a barrel back in late September, here we are today trading under $70 a barrel, and that's the biggest variable in inflation and one of the biggest cost drivers for a lot of products, service and industries. And so this lower oil helps inflation, the Fed, and you would think it would help Biden's chances of being re-elected as well, with Americans paying less at the pump, helping the economy stay afloat. However, even with inflation coming down, gas coming down, stock market ripping up to highs, Joe Biden still has one of the lowest approval ratings ever for an American president, coming in at just 37%. However, that doesn't mean that's bad news for the stock market, because looking back in history, according to research, suggests the bulls may have more room despite the excessive investor optimism. Because looking back in history. When the Gallup poll presidential approval rating is between 35 and 50%, Dow Jones Industrial Average has delivered an average annual return of 9.9%. When the approval rating is higher, between 50 and 65%, that drops down to 7.6, and when it's above 65, that drops down to 2.4. And it doesn't really say why that is the case. However, if I was to take a guess, it could be because an incumbent president with a low approval rating may be willing to spend a bit more of taxpayers' money to try and shore up some votes and throw some favours out there. Things like cancelling student debt loans. We may see some other things as Biden tries to buy some votes going into November election next year. We also got billionaire bond investor Jeffrey Gundlach saying the 10-year Treasury yield will fall to 3% next year. Said bonds are going to continue rallying. And he went on to say they're just going to cut by 0.75 of a percentage point or so, says the Fed. I mean, I think that's pretty unlikely. I think that if they cut rates that much, they'll have to cut them more than that. And yields definitely did react to that data we got today, especially up the front and the Fed sensitive 2-year rate. And just taking to a 5-minute chart on the 2-year government bond yield. Before the Fed come out, it was trading at about 4.67, and huge move for the last 2 hours of the trading day afterwards, fallen 25 basis points. Same with the 10-year. Before we got the news, it was 4.16, and we fell about 14 basis points, just trying to hold on to the fall handle here. And staying on the 5-minute chart, just looking at the S&P 500. There we are before the Fed. 46.45. Algos kicked in. We absolutely shot up. Now holding above 4,700. Taking you out to a weekly chart. We're not too far from all-time highs on the S&P 500 at 48.18. Nasdaq 100 index sitting at all-time highs now. And the Dow Jones Industrial broke out to new all-time highs today. And just going down to the daily chart, look at that melt up in stocks, and even more so in the Russell 2000, up 3.39% today, and microcaps up 3.86%. For those of you who regularly watch my channel, you'll remember back here I was saying a lot how cheap microcaps are, technically and fundamentally, and from that low we are already up over 20% and putting in a really significant bounce here on breadth, which I'll come back to a bit later on the chart, so stick with me. So as I've been saying for a few weeks now, the bulls have a lot to cheer about and hang their hat onto. It does have a lot of good things going for it. They're very hard to argue with, and there's no doubt the bulls are in control now, with the Dow breaking out to all-time highs, along with the biggest stock in the world, Apple, hitting all-time highs and adding over $1 trillion in market cap this year. And thus far, the stock market has absolutely defied past patterns of the aggressive Fed rate hikes, and it could be a case that AI bailed it out and certainly helped the Magnificent 7 stocks rip up high this year. And we've even got JP Morgan strategists calling for more of the same, saying Amazon and Alphabet are its top picks for next year, betting that the mega cap tech rally will continue. They see 21% upside and 29% upside for Alphabet and Amazon, saying they anticipate internet companies will re-accelerate revenue growth to more normalized levels. They expect Amazon to grow its total revenue by 13%, with a lot of that growth coming from the cloud, AWS of 17%. They expect Alphabet to grow 11% in revenue, with improving search, YouTube growth, and AI ad tools. And they very well could be right, because analysts overall are expecting S&P 500 companies to deliver double-digit earnings growth next year. For the calendar year 2024, they're expecting 11.8% in earnings growth rate year over year, which is above the trailing 10-year average of 8.4%. They predict all 11 sectors to deliver year-over-year earnings growth, with the leaders being healthcare, communication, and information technology. And once again, that would be truly remarkable if we saw another year of mega cap tech outperform, considering a composite index of those large 7 stocks is up 104% this year. It's truly spectacular growth and completely reversed all the losses from last year. I'll come back to the stock charts later, but moving on to commodities. We've got Russia's weekly oil flow spiking to the highest in 5 months as OPEC and its allies grapple over cuts to output. And this comes as OPEC Plus nations have vowed to slash crude production to try and stem a months-long slide in prices. The cartel agreed to slash production by a collective 2.2 million barrels a day for the first quarter next year. And some of those cuts, though, are supposed to have already been implemented by Russia. And it's really the Saudis that really want their allies to cut production, get the price of crude back up. But US production continues to boom and the market is awash with supply. And so now they're trying to talk the price up, with OPEC saying it's exaggerated concerns about demand are hitting oil prices, acknowledging there may be a slowdown in economic growth next year, but saying that the worry was excessive, and once again blaming it on speculators, saying they played a major role in this trend. And like I said, that lower oil price really helps out us Western countries. It's helped bring inflation down, it's helped bring interest rate expectations down, and it should have helped the Biden administration like he wanted it to. However, that doesn't look like to be the case. And so we did get a little bit of a bounce off the mid 67 levels today. One would have thought we got a bigger bounce with rate expectations coming down a lot. That should help drive demand. However, it was pretty soft trading on light volume and crude. Same with natty gas, which is pretty technically oversold here. Could be close to putting in a short-term bottom. And staying on commodities, it was more gold loving it. Gold loves those lower real rates. Got a nice pop up there today, back above 2,000 an ounce. And we'll just have to wait and see whether it takes another stab at those all-time highs when we got that big kind of blow-off reversal top. That is still yet to be really seen whether it's going to play out or not. Moving on to cryptos, we've got some research saying Bitcoin likely to extend its rally for at least another year if this historical pattern holds true. That's the so-called one-year hodl wave, an on-chain metric which tracks the percentage of Bitcoins that have not moved between wallets for at least a year. Historically, as Bitcoin price climbs to a cycle peak, there's a reduction in the percentage of coins held for longer than a year, as some holders choose to capture their profits through selling. So like we can see in this chart here, the one-year hodl wave often declines as Bitcoin prices rises. And so far for this cycle, we haven't seen any clear indication that the indicator has topped out. And there's the correlation between the anti-fiat assets, Bitcoin and gold continuing. It too having a bounce back up today, maybe turning that 40,000 resistance level into new support, and it too may have another stab at yearly highs here soon. Moving on to one of the best performing large cap stocks this year, Eli Lilly, now the largest healthcare stock in the world, and billionaire investor Ken Langone, one of the co-founders of Home Depot, said Eli Lilly will be the first trillion-dollar drug company in history, citing its successful management and strong R&D spending, and they've also been riding the GLP-1 drug train. Those appetite-suppressing drugs have really been good drivers of these stocks like Eli Lilly. Now has a market cap over 568 billion, and just looking at a weekly chart of Eli Lilly, just been in a parabolic uptrend for over a decade now. Here we are at almost $600 a share. However, it has got a very rich valuation, PE over 100. My stock fair value indicator's got it at 291, saying it's about 100% overvalued. Contrasting that, former leader of the drug industry for many years, Pfizer, fell again today after the company slashes guidance. They haven't been riding the new blockbuster weight loss drugs. Instead, they're struggling with earnings and revenue underperforming from the collapse of the COVID-19 market. They expect to combine $8 billion in revenue from COVID-19 products, well below analysts' expectations of $13.8 billion, as a lot of people are not choosing to get boosted, and we are getting a bit of global immunity out there to COVID. And just looking at a weekly chart of Pfizer, it is always darkest before dawn. Going down to the daily, here we are today, falling 6.7%, putting in a bit of a dip by hammer candle formation. A lot of volume coming into the stock, 157 million shares today. I'd say there's a lot of big value investors coming in there because it has a PE of 15. My stock fair value's got 131, making it about almost 80% undervalued, with a dividend yield of 5.7%. So I'd say this stock is largely de-risked, and at $26 a share for a stock like Pfizer, we may look back in a few years and that may look like a very attractive level to enter. Moving on to the Fear and Greed Index. That climbed a little bit again today to 69, and corporate insiders still taking advantage of these elevated prices, doing a bit of selling up here and not so much buying. And my institutional buying percentage indicator still in neutral zone at 50. I've still got the S&P 500 oscillator climbing again and walking the line, and a clear sign of this parabolic momentum in the market. And this is a market that is really tough to short, and who knows how much higher it can melt up. It may even go into a crazy blow off top, could be hitting new all-time highs on the S&P 500 in the coming days, if not next week. And just looking at breadth, we've got 886 stocks and ETFs breaking out to new 52-week highs today. Some of the notable ones: Amazon, JP Morgan, Home Depot, Coinbase, and a few semis and tech stocks in there. On the other side of the coin, we've got 98 stocks and ETFs breaking down to new 52-week lows. Top of the pack is Pfizer, bunch of short ETFs, and once again, no love for China, doing the complete opposite of what American stocks are doing. Big climb up in the amount of stocks above their 200-day average long term, 71%, and the traditional NYSE and NASDAQ new highs, new lows also breaking out. A lot of strong breadth out there. However, volatility didn't drop on an up day. Actually increased a little bit, but still super low here in low 12s, and a little bit of an increase in the volatility risk premium. But once again, option dealers absolutely nailed it back here in their pricing of options. They saw this rally coming. That's why they dropped their implied volatilities, and they front run the Fed pretty good. Actually saw a bit of increase in the put call ratio and the skew index as well, jumping up 152, the price of out of the money put options. As a look at the daily chart of the 2-year government bond yield, huge fall today, and that's great news for bond prices. I think it's safe to say TLT has put in a bottom there in the low 80s. Here we are climbing back up towards $100 a unit on strong volume. And look at that rip up in high yield corporate bonds. Almost double average daily volume. Huge move, 1.53% for high yield bonds there. And as yields fell, so did the dollar, which helps risk assets. Nice move up in Canada's TSX, and the European and Asian Pacific indices had all closed their Wednesday sessions before the Fed had reported. And look at the growth versus defensive sector spread. Mega cap tech was actually soft today. That's where we got a bit of a downpull in that. Still got high beta stocks though moving up. And there's the move up in the Russell versus large caps. Starting to outperform here. You can also see that in micro caps versus S&P 500. Looks like it has bottomed and moving up pretty good, along with the Russell versus the Nasdaq as well. And we've got inflation expectations continuing to move down. Over to stock sectors today, the winner by far, junior gold miners up 7.2%. Coming in behind that was clean energy. May have put in a bottom here with this big volume thrust up. 6.9%, and coming in third was cannabis, MSOS. Couldn't really see anything yesterday why it fell so hard. Could be a case of someone knows something, maybe thinking the DEA is not going to reschedule anytime soon, and this just continues to remain a very volatile sector and will do for a long time, as it's hard to have faith in our politicians to do the right thing. It's got a big move up in ARC Innovation, 3.7%, and look at these moves for a VIX 12 environment. Regional banks up 5.8, biotech up 4.8, REITs up 3.6 on volume as well. And the other sector yield investors love, utilities, 3.7%. They compete with short-term government bonds, money market funds. And with rates dropping, that big pile of cash may be finding some of its way back into yielding stocks here. BlackRock Barometer did a good job at letting us know the market's mood. Big volume thrusts up, parabolic short-term uptrend. JP Morgan, the best performing bank of all of them. There's a look at Apple breaking out to new all-time highs. Microsoft was bang on flat today. Same with Alphabet. NVDA at 480, not too far off all-time highs either. There's Amazon breaking out. Tesla still tracking sideways. Meta not too far from highs, and same with Netflix. Really good day in the meme space. Highly valued, high beta stocks swinging really higher. And defense contractors still trading pretty good here, breaking out as well. There's my favorite utility, renewable energy stock NextEra, breaking out up 5% today to new multi-month highs. And these old economy stocks still doing really well. Looks like General Motors has put in a bottom after we got down to those low 27s, and same with my other old economy favorite, Walgreens, having a nice pop today, 7.4%, just getting above these highs back in mid-October by a few ticks. Macy's still holding up there, and look at those vulnerable regional banks that were close to going under back in March, popping up really good here today, along with their big guys continuing their short-term parabolic uptrend. Okay, so there we are, guys. Melting up in the stock market. Beautiful technical pattern, getting these nice volume volatility increases. Then we coiled up there. Market wasn't sure what it was going to do. And then here we are uncoiling again today on the back of the change in the Fed dot plot. Stock market loving the idea that the Fed is done, and the idea that they'll cut rates without a recession or something major breaking. That helps the relative attractiveness of stocks versus bonds, lowers the cost of capital for businesses and consumers, and with that lower price of oil, corporate profits up, everything is looking a-okay for the stock market. And it's going to the weekly chart. Look at the Dow Jones Industrial, those large old economy stocks breaking out to new all-time highs, and comparing that with the Russell 2000, still has a bit of work to do for it to break out to an all-time highs, and this could still be a good catch-up trade going into next year, along with micro caps, which had been beaten down even more and still have a ways to go before they can even get close to all-time highs. Around 160 a unit, here we are at 110. Still a lot of good value to be found in that space, and they've already bounced 20% over the last month and a half. That's all I've got for you today, guys, and just before I go, just to let you know of my Christmas special, head on over to my website, clickcapital.io, click on the big red banner up the top, and you'll come to my Christmas special page, where you can get lifetime access to all my custom indicators I've developed and coded up over the years, like all the ones you saw me use in this video and a lot more, plus access to my latest investment presentation, micro cap stock I just invested in recently, which since I released it about a month ago is already up about 10%. I still think this is just the beginning. I'm looking for at least 100% gain on that stock. That's a 45-minute video presentation. You'll get that, all my custom indicators for TradingView, all ones I develop in the future for just a one-time fee of $249. That comes with a 7-day guarantee. If you change your mind, I can issue a refund, no problems. However, once you see all these indicators and try them out for yourself, you won't want to do that. You want to hold on to them and get all my future indicators as well. It's one of the lowest prices you'll ever see me sell them for. And like I said, that includes access to my latest investment presentation, and you'll be on my members list to get future discounts as well. So if you're interested in learning more about that, head on over to my website, clickcapital.io/Christmas, and take advantage of this special offer. Valid only until Christmas Eve. All right, guys, thanks for tuning in, and I'll see you again tomorrow night. Cheers.